In the last 18 months, I've spoken to well over 1,000 investors that have all asked me one question. That is now the right time to buy an investment property? So in today's video, I'm going to talk about why 2019 on one hand is the best time to buy investment property in the last decade, and why 2019 is also the worst time to buy an investment property in the last decade as well. Now in 2019, there's a lot of fear mongering going on because people don't like losing money on their assets. People don't like seeing their property prices going down. And unfortunately, in places like Sydney and Melbourne, as well as Perth and Darwin, we're seeing that. But for people in Sydney and Melbourne, a lot of investors, a lot of mums and dads that own their own homes have a really short-term memory. And so their short-term memory has shown them that recently in the last 18 months, their prices have been declining. And then before that, their prices rose rapidly. So what's been happening is the media has been absolutely hammering property for a few years in Australia now. The banks and APRA made it really difficult for the banks to lend out money to investors, which has put a huge halt on the crazy amount of speculation and growth that was going on in Sydney and Melbourne, which I personally believe is a fantastic thing and absolutely needed to happen to stop us from going into something that could have been a lot worse if it was still occurring today. So in today's video, I'm going to really break this down. I'm going to talk about markets and where each of the different markets in Australia are at. I'm going to talk about the bigger picture real estate cycle, as well as some of the positives and negatives about the economy and the real estate market in Australia as it stands now. And then I'm going to talk about a strategy that I'm using personally in 2019 to set myself and my family up for the long-term financial freedom that we're after, and how I'm using this year, where most people will actually sit on the fence and do nothing, as an opportunity to buy, which in some markets in Australia would be a really bad time to buy, either Sydney or Melbourne, for example. Other markets like Brisbane are probably positioned to be the best marketplace in terms of buying that we've seen there in the last decade. So it is a year where we have to be cautious, and this is certainly not advice. This is not financial advice, legal or accounting advice. I'm certainly not saying to anyone, rush out there and go buy investment property. But what I am saying is start to educate yourself, start to get a plan in place, start to identify where different markets are at, and then, make a decision based on your financial situation for your own life. Now, the first thing I wanted to say about markets is really that there is really no Australian property market, because Australia is a series of states with cities and regional areas within those states and small towns as well. And then within those cities, towns, regional areas, there is suburbs, and some suburbs are quality and some suburbs are very average. And then there's pockets where there's quality pockets, like the Northern Beaches in Sydney, for example, and then cheaper pockets like the western or deep western suburbs of Sydney, for example. So in every marketplace, they need to be reviewed collectively, obviously, and that's what the media is great at doing, talking about how Sydney prices are declining or Melbourne prices are declining, or the fact that Australian prices are declining. But to be a good investor, you take that stuff with a grain of salt and you really reduce it down to the local level. And so if we look at the guys that do this professionally, there are really two companies that come to mind. The first is CoreLogic, who are Australia's leading property analysts, And those guys are the big aggregator. They get all the data, and each month they create a really nice report which you can subscribe to through their email, or a really nice video, which I like because it's like a 10-15 minute video on what's going on Australia-wide, and then I can take that information and decide to do with it what I like. So they've said that in 2019 we should expect to continue to see further declines in Sydney, Melbourne, possibly Perth, and definitely Darwin. And other people like Simon Priestley and Heron Todd White put those markets in the same position. But then they've started to talk about, in recent videos, not short-term potential, but medium to long-term potential for other marketplaces in Australia that are still very affordable when you compare them to long-term averages against wages, for example. So they've said that places like Brisbane, parts of southeast Queensland are now experiencing nice population and income growth against those jobs, and at some point in the future, you know, we hope that that translates into growth of some sort. Now, Heron Todd White is another analyst who do a really, really nice report called the Month in Review report, and in their clock for March or April 2019, they've put Sydney and Melbourne at the declining phase of the market. They've put Perth at a declining phase as well, close to reaching the bottom. They've put places like the Gold Coast, for example, at the start of the decline. But then they've put other marketplaces like the Sunshine Coast at the rising market phase. They've put Brisbane at the start of the recovery phase, and they've put places like Adelaide and Canberra at the rising market phase. So again, because we know that Australia isn't one big marketplace, you can use this information from people like CoreLogic and Heron Todd White to get access to information that most Australian investors don't look at, so that you have a buying advantage. And if nothing more, you can keep your finger on the pulse of where things are going. But if you are thinking about using this year or next year to your advantage, then you can really hone in on which marketplaces you should be considering. Now, when we talk about long-term averages, looking at Homely's data on the last 46 years in Australia, the three marketplaces that have performed better historically than anywhere else are Sydney, Melbourne and Brisbane, with Brisbane over that time being the top performer, increasing by 9.7% per annum over the last 46 years according to that Homely report. Sydney being number 2 at 9.6 and Melbourne being number 3 at about 9.6% per annum as well. Now, in the last 20 years, Sydney on average has grown by 8% per annum, where Brisbane's done 6%. And then if we look at the last 10 years, Sydney and Melbourne have grown on average by about 7% per year, where Brisbane has literally grown on average by literally 1%. So what I like about understanding the bigger long-term picture is we know that long-term Brisbane's going to be a marketplace that a lot of Australians move to. It's going to be the same size as Sydney and Melbourne. We know in Brisbane, according to the Australian Bureau of Statistics, that the wages are now exactly the same per household as they are in Melbourne, and just slightly less than Sydney, but they've been catching Sydney in the last couple of years, and that we know more Australians are moving here than anywhere else. So in terms of knowing that the long-term performance has been solid, while we can never predict the future, particularly in the short term, you can use the past as a little bit of a guide for realizing that just because a market hasn't done well recently doesn't mean that it doesn't have long-term potential. And there was another period in an 11-year period where Brisbane didn't receive any double-digit growth in that 46 years as well. There's periods where Sydney grew by less than 1% per annum for 9 years. So these things do happen, particularly after a big bull run or a big boom. You know, they either recorrect or they sit flat for a long time until wages catch back up. Now, for those of you like me that are interested in the history and understanding the market and cycles, you can start with Phil Anderson's book, The Secret Life of Real Estate and Banking, or you can check out Fred Harrison's book, The Power in the Land or Boom and Bust. And these guys have done what you and I don't have time to do. So Phil went and looked at 250 years worth of booms and busts in America. Fred went and looked at 350 years worth of booms and busts in the UK, and what they both found is that there's this larger, bigger picture cycle. Now, the reason I bring this up in today's video is to explain that right now we are exactly where we are supposed to be based on the history at this stage of the cycle, and that is property prices rose very, very quickly out of the last GFC because the Australian government and the banks pumped cheap money back into the economy so that we'd all go out and spend it and things would start turning again. And that happened around the entire world. Europe, America, Asia did the same. And then what happens is everything gets expensive. Well, at least the markets that perform well out of a GFC, the big ones like your Sydneys, Melbournes, your New Yorks, the big cities in Singapore, the big cities in parts of China, for example, the big cities in Europe like London, they get to a price point where they just can't afford to continue to do that. And then we get to this phase which is called the mid-cycle slowdown point. We get to this part based on Phil Anderson and Fred Harrison's work, which is called the mid-cycle slowdown, and that's where asset prices are high in the stock markets, in the property markets around the world, and we get a period of about 18 to 24 months historically where asset prices decline or sit flat over that period of time. And over that time, this is exactly what we've been going through in Australia for the last year in terms of Melbourne and Sydney. Prices decline, the marketplace at first feels very, very uncomfortable about those declines, and that is going to continue to happen this year. I expect to see a 6 to maybe 9 or 10% reduction in both Sydney and Melbourne this year, as long as money doesn't become a lot easier to access very soon. And then what happens is people go, well, I've been sitting on the fence for 2 years doing nothing. Prices have declined a little bit. I feel like I've got to get on with my life. And then we get into the second half of the real estate cycle, where historically in certain marketplaces, sometimes, Sydney and Melbourne do okay, but generally it's other markets in Australia that perform better in that second phase based on my analysis of history from Homely. And then we get into the top of the marketplace where we have another GFC style event, a depression, or something like the recession we have to have in the 1990s type thing. And you've got to remember this, like all of this stuff is in history. It's all documented. Between 1988 and 1990, property prices in Sydney declined by 25% in 18 months. So that's a significantly sharper decline than we've had. But for those of us that know their history, in the last 30 years, including that period of time, asset prices in Sydney have still risen by an average of 8% per annum. So there is a cycle. Property prices go up and they go down, and your job as an investor is to understand this and take advantage of it. So 2019 isn't the year to buy Sydney and Melbourne, because even if prices from top to bottom, like top being 2017 and bottom being 2019, declined by 20%, you've got to remember that they went up by almost 80 to 100% over the 5 to 6 years before that, meaning they're still significantly up when you talk about 10-year averages, and a lot of the future growth has already been priced into the marketplace. So some of the positives that I wanted to explain in this video, just to give you a little taste that there are good things happening, is first and foremost, for the first time in 12 years, the budget is now falling into surplus, which is absolutely beautiful. It means that the government has extra money that they can invest into pumping up the economy, helping people get additional jobs, creating additional services, putting more money into infrastructure, healthcare, schools, hospitals, all of that important stuff, as well as pump money back into the economy and businesses so that people can start having a little bit more confidence around things. And I think that is really going to help. And I think confidence will be back in the marketplace by, I'm already starting to see it now. People having very different conversations with me than they were 12 months ago. At some point, negative news is not going to sell anymore. Asset prices in Sydney and Melbourne will stabilize. Confidence will be restored. Money is already beginning to move around the economy in terms of APRA lifting some of its restrictions and some of the speed bumps on investor lending at the moment, and the banks being open for business again. Now that'll take 12 months to come through, but you don't want to wait until people start looking to buy again. You want to take advantage of conditions as they sit. Obviously, Australia's population growth has been hectic. They're expecting 350,000 more people into Australia this year. In the last 2 years before that, 700,000 people were born or moved into Australia. Unemployment rates are very, very low, and I think the fact that the government's moving into a surplus can help with that. Obviously, there's some incredible infrastructure projects in all sorts of different areas around Australia, and we're seeing for the first time in about 7 or 8 years, actually probably more like 5 to 7 years, a snippet that mining actually might be starting to come back, and actually, companies are starting to employ again. It's one of the fastest growing industries according to Seek in Australia as well. Obviously, there's still negative stuff, and that's why I said that this could be a good year for some people. It will be a bad year for others. But it is an election year, and people don't like to make decisions until after an election. I have absolutely no why, because this is now my 3rd election that I've been buying property in, or 4th. And every time there's an election, I can buy properties cheaper because people that don't know what they're doing sit on the fence and wait for it. Sentiment is also low. People don't like losing money in Sydney, Melbourne, Darwin or Perth. And so some of those people that would be taking action are just sitting there doing nothing, waiting for things to work out. If you've got a 15 to 20 year plan, you know, based on the history, things should hopefully work out in your favor, but I can't guarantee that, which is why I have a strategy that hopes for long-term capital growth, but also seeks out, you know, short-term cash flow so that I can own properties outright and have a good passive income for life from there. So sentiment is still low, and it's going to continue to be low for a while now. What I've realized with property market from being in it for 11 years now is that generally the general public is at least 1 year to 2 years behind what's actually going inside the industry, and so they're responding to things significantly later. People should have been really, really fearful in 2016, 17 and stopped buying in Sydney and Melbourne at those points if they knew their history and if they knew the changes that had just been made around money. It was very, very clear, if you had been following CoreLogic stuff, Homely stuff, Heron Todd White stuff, that marketplace was overcooked and a correction was coming. But unfortunately, people get emotionally attached. They think they can make short-term money without having to work for it, and therefore we get the top like we did. On the flip side of that, smart people are beginning to get their head around markets like Southeast Queensland, Brisbane, North Brisbane, Sunshine Coast, where population and jobs and infrastructure is just set to be insane over the next 10 years, and where prices are still very, very, very affordable, and in some instances, you know, effectively cheaper according to CoreLogic than they were to buy in 2008, being 2019 now, particularly in Brisbane. So that's interesting. The media has been hammering property and giving it a peppering. You know, the Today Show, A Current Affair, the news channels. Bad news sells, as we all know, and property has been bad news for a couple of years now. At some point, that's not going to sell anymore and things will turn around maybe. And money is still difficult to access, because while APRA has, you know, allowed more investors to start thinking about borrowing money again, and the banks are open for business again, and the interest-only loans and principal and interest loans have rebalanced, and some of the big banks are only asking for 10% deposits again rather than their big 20%. You know, they are still making it quite tough after this Royal Banking Commission and scrutinising, you know, people based on a worst-case scenario event. So that's healthy. I love that. And I'm a long-term investor. These short-term things that happen to control prices have little impact on my long-term averages, because you've got to remember that for 200 years in America, Australia and Europe, governments and banks have been artificially increasing or decreasing the values of assets, and that's going to continue to happen. If your strategy is long-term, then hopefully all things will work out for you. Now, what I wanted to finish on in terms of, is 2019 the best time to buy in a decade? It certainly isn't for Sydney and Melbourne. The best time would have been 2009. The next best time would have been 2012. But for places like Brisbane, it absolutely looks like things are lining up for a positive next 7 years. Now, I don't have a crystal ball. I have no idea where the performance of the market is going. But if 7 years from today, property prices are still completely flat, that means that property prices in Brisbane, when you factor in inflation, haven't risen in 18 years, and there's no precedent for that in Australia. So, you know, my strategy personally moving forward is obviously low risk. You don't do anything this year without the support of someone who knows what they're doing, or without being in a financial position where you can cover a worst case scenario, and where you understand that this is a marketplace right now, particularly 2019, where opportunities are around. We're buying houses in some instances 20, 50 grand below what we could last year. I just bought a property for myself, a piece of land, where the person selling it to me literally lost $100,000 to give it back to me. Those types of opportunities are around, but you need the right plan in place, and you need a very, very low risk approach and a long-term perspective to make a marketplace like this work. You've also got to understand that, you know, it's going to feel a little bit more uncomfortable, because the herd isn't moving into property right now. The herd is moving away from property because the herd is now fearful and they're spooked. And, you know, that is my opportunity as a buyer and as a buyer's agent that helps our clients buy properties to pounce on that, to take the opportunity while it's there. And right now, and the next 18 months are going to be the opportunity for people if they're interested in buying at the bottom of the Brisbane market in particular for at least the next stage of the cycle we're going into, according to my analysis of what CoreLogic, Heron Todd White, BIS Shrapnel, Michael Matusik, and a lot of other people around Australia that I respect the opinions of are saying. Now, my strategy isn't the old go buy and hope. My strategy is to time the right market. So that would have meant Sydney and New South Wales in 2011, which is when I started to buy those markets after the GFC. And then I started to move into the Brisbane market, Southeast Queensland market, Sunshine Coast markets in 2015, which historical timing shows was a nice position to start coming into them. Now, Brisbane lagged a little bit longer than expected because I think Sydney and Melbourne went crazy and money became very hard a couple of years ago to borrow, which is why the second thing outside of timing is I buy quality areas like Sydney, like Brisbane, for example, that have had a history of long-term performance. I also buy high-quality houses on big blocks of land close to the city and closest to the beach. And I buy properties with strong cash flows. So I don't like to buy a property for $1 million that gives me $600 a week. If I'm spending $1 million, I want to be getting $1,000 to $1,200, $1,500 a week of rental income from that expenditure, because I want to be in a cash flow positive position so that I can take advantage of market conditions as they arise, and so that when I own that property outright in the future, which is my goal, I've got a great income for life from that asset. I also want to take advantage of that timing thing by buying assets at times when not everyone else is, and buying at or below market value with a property that I can do something to in the future. And then the last thing, which is the fifth thing, and the furthest from my control, is just buying with the long-term potential for growth. Now, you don't know, I don't know what's going to happen this year or next